Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Sumit Handa, Managing Director and Co-Head of the Investment Committee at Pennington Partners, a multifamily office. We're going to discuss recession, interest rates, and geopolitical realities that the market is facing. Sumit, it's great to have you with us. Welcome to TradeTalks.
Thank you, Jill. Pleasure to be here.
Let's talk about timing of this recession that has yet to materialize. Does it happen this year, next year?
Yeah, I mean, economists have predicted 9 of the last 5 recessions, right? So they have a consistent track record of being wrong. The challenge right now, there's a multitude of factors. And so, if we think of the economy almost like as a bathtub, right, with water, and it looks like it's very calm. Underneath, all the atoms are moving around. There's so many variables that go into thinking about this. And so, but to answer your question directly, we believe that the recession is going to happen, but it's not going to be this year. It's going to be sometime next year. We think it's been delayed, certainly by the job reports that came out this morning. We saw the strong number that came out of ADP. We think inflation has been slayed, if you will, by the Federal Reserve. And the consumer remains fairly resilient. So for all of these myriad of reasons, and we can talk further about that, but we think the recession sort of it's not today, right? It's not today.
Well, let's talk about the consumer for a moment here.
Please.
Because really have held up strong. I mean, it really has been what's driving the economy here, but it's going to get harder to borrow as interest rates continue to go higher, and at some point spend should be impacted.
It has, and so to answer your question, let's go in reverse order. With respect to the consumer, labor markets are very, very strong right now. There's about 1.9 job openings for every one individual. And so if you're looking for a job, it's a great time to find one, and wages have been strong. And so consumer is feeling confident, they have a lot of money, they can go out and spend, and we're seeing that out of MasterCard and Visa in terms of the spend. We're also seeing it in luxury items in terms of people who are spending money on LVMH in terms of Louis Vuitton bags or even Porsche cars. So we're seeing it everywhere. With respect to that, one of the challenges, obviously, is that the consumer also got a lot of money in terms of stimulus from the government during COVID. And we're about $530 billion left of that stimulus. It's still in the pockets. It's coming to sort of an end.
I'm surprised it's been around that long, honestly.
Yeah,
I mean, we're not the best savers.
No, we're not. And people are still spending, but it's coming to an end. And so once that comes to an end, our belief is sometime maybe September or October, it could be another month or two, consumers will start cutting back on spending. With respect to lending and borrowing, obviously interest rates have gone up, and we've had a regional banking crisis. And so the banks have also tightened standards. And so, yes, it's not just the consumer that is going to get, impact, it's also corporations. And so corporations, what do they have? Their largest component is labor, right? And so if corporations are not able to borrow, eventually that's going to impact the labor market, meaning they're going to start unemployment. But as of right now, that really hasn't manifested itself. We believe it will happen. It's just not today.
So let's talk about interest rates for a moment here.
Yeah.
We saw the strong ADP data. Challenger had some good data. JOLTS came out today, way higher than everyone's expectations. And we see the market reaction because of that, suggesting that perhaps maybe we do need to have a couple more interest rates to cool this economy down.
Yeah, so there's leading, coincident, and lagging indicators. And so leading indicators are housing and permits, and they've been on a decline, right, because interest rates have been high. Coincident indicators are the GDP numbers and unemployment numbers that we're seeing. They are sort of suggesting that we're not in a recession. GDP numbers in the first quarter were 2%, even though we had this quote unquote regional banking crisis. And the labor markets are also resilient. So with respect to, and the lagging indicators are also suggesting that, in terms of interest rates, that's the last piece. So interest rates are a lagging indicator. And so what's happened is that you're seeing leading indicators starting to slow down. The coincident indicators are still kind of firm, and lagging indicators are still high. With that said, our expectations are that rate hikes are, whether it's, another 25 basis points or not, the Fed is certainly closer to the end of its rate hike campaign than it was when we started last year. And the rate of change that's occurred, think about it, it's gone from 0 to about 5+% where we are today. The speed at which it's happened, that is enormous. We've never seen that kind of rate of change before. And so the policy effects of that will be felt sometime in the second half of the year, first quarter of next year. We still haven't felt all of it yet.
Yeah.
I know it's a long-winded answer to your question, but I think it's very important to understand how long this takes.
Yeah, well, I think it's a great point that you make there. Let's talk about the geopolitical realities as well. I mean, we think very U.S.-centric in what the Fed is doing, but other central banks are making moves of their own.
They are, and you know, as you correctly stated, you know, the United States is not Tom Hanks and Castaway, right? Like, you know, playing with volleyball, right? We're in a global economy. It's a $90 trillion global economy. There's $20 trillion that, you know, in terms of merchandise that's exchanged throughout the world every year. $6 trillion in terms of services, and if we look at a map, just when Castaway was released in terms of a picture, which was about 20 years ago, the United States was the world's largest trading partner. Today, it's China. And so last year, China was obviously shut down because of COVID, and they had a zero COVID policy, for better or for worse. It's not my job to opine on that. They reopened. They injected over $1 trillion of liquidity into their markets and into the world, and money is fungible. It goes everywhere. And so that liquidity sort of helped stem the tide, if you will, in terms of providing support for markets. And so, but they're not the only ones. You know, the Bank of Japan has engaged in YCC, and also even the United States, for that matter. While on one hand, you know, Jay Powell was cutting, you know, or sort of cutting back on how much liquidity was provided through the M2, because of the banking crisis, he injected a lot of monies through what is BTFP, which is the funding program for the banks. And so that digital currency is sort of, you know, gets rehypothecated and gets circulated into the world. You're starting to see all of that, and that's causing, you know, sort of the rally that we've seen in the markets. There's a direct correlation between liquidity and the markets. It's over 90%. So.
Yeah, and then to your point, I mean, all these lagging moves still have to take effect, and the lagging takes longer than the actual policy moves
right.
take place. I mean, 9 months.
All right, I mean, it's sort of like if you think about someone, you know, drinking, you know, if you go to a bar and you start taking shots, you may not feel the first, you know, if you take the first shot of tequila, you're not going to feel it right away. It's going to take time, right? You have a second one or a third one or a fourth one. Finally, you're going to get that hangover, and it's going to be the next day, or you're going to have other issues.
That is the best analogy I've heard to describe this, Sumit. Appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.